Hello friends. Today's topic is tracking error, the hidden number you must know before buying an ETF. Most ETF investors look at expense ratio and past returns. But there's a secret number, tracking error, that can quietly eat into your returns. Today, we'll understand what it is, why it matters, and how you can use it to pick the right ETF. What is tracking error? An ETF's job is to copy the performance of its benchmark index, say the Nifty 50. But in reality, its returns will never be exactly the same as the index. The difference between the ETF's returns and the index's returns is called tracking error. Here in this table you can see there is a 0.1% gap for SBI Nifty 50 fund in terms of returns, and this is a tracking error. Tracking error is measured as the standard deviation of these differences over a period, usually 1 year or 3 years. Why does tracking error happen? There are several reasons ETFs can't perfectly match the index. Expense ratio. The annual management fee reduces returns. Cash holdings. ETFs sometimes hold cash instead of being fully invested. Dividend treatment. Delay in reinvesting dividends can cause gaps. Rebalancing lag. Index changes take time to reflect in ETF holdings. Transaction costs and taxes or costs from buying and selling securities. Why tracking error matters? Imagine two ETFs tracking the same index. ETF A. Expense ratio 0.15%, tracking error 0.20%. ETF B. Expense ratio 0.10%, tracking error 0.70%. Even though ETF B has a lower expense ratio, its high tracking error means it's doing a worse job copying the index, costing you more in the long run. How to use tracking error when choosing an ETF? When comparing ETFs, look for low expense ratio. Check tracking error. Lower is better. Prefer funds with high liquidity and consistent performance. For example, if two ETFs have the same cost, choose the one with a tracking error below 0.5% over the last year. Expense ratio tells you the cost. Tracking error tells you the quality. Choose wisely, and your ETF will truly match the market you're investing in. Invest smart. Track the error before it tracks your money. Hit the subscribe button for more ETF insights, and let's grow together.